Hi, and welcome once again to another session in the topic area of quantitative methods. And today's topic is going to be about time value of money in finance. Now, this particular chapter is again just like the chapter before of that of rate and returns, is not only important from the point of view of the curriculum relevant to your quantitative methods, but of course, this is going to be the bedrock of 90% of all the subjects that you're going to actually study, save the ethics, I think. Uh, we're going to learn a great deal about the time value of finance, time value of money in finance, and I'm for this particular chapter, I'm going to adopt a separate strategy. Rather than me being verbose and reading through the slide or trying to explain each and every uh, bullet points, I think the best way to learn the time value of money is by solving the problems. And the reason that why I insist upon learning that in particular also has got to do with the calculator under consideration. In particular, we are going to talk about the TI BA2 Plus and TI BA2 Plus Professional calculator, and all our working are going to be based on that. The reason again being that even though we have the HPC 12 also as one of the approved calculators, but more than 95% of the candidates that I'm aware of, since my days of actually taking the exam, people actually do resort and people actually do prefer the TIBA2 plus calculator. Nevertheless, so let me first go through the learning outcome statement. And I quote, calculate and interpret the present value of fixed income and equity instruments based on expected future cash flows. Calculate and interpret the implied return of fixed income instruments and required return and implied growth of equity instruments given the present value and cash flows. Explain the cash flow additivity principle, its importance for the no arbitrage condition, and its use in calculating implied forward interest rates, forward exchange rates, and option values. Typically, we will exclude from this particular tutorial of ours, we're going to exclude this LOS. The reason being, it is my considered opinion that unless you know option, unless you know about the binomial trees and other option pricing model, it actually should not make much of sense. Uh, to talk about the option valuation in your quantitative method. Option valuation and about options, things pertaining to options, better be learned when we learn about derivatives. All right. So, so as you would be knowing that, time is money, money is time, and that's interchangeably correct. I think our previous chapter has already cemented that fact, and that learning should be quite established with all of you. Now, let me also tell you that the different applications that we're going to learn when we talk about the TVM or the time value of money in particular. First and foremost, valuing a fixed paying instrument, for example, bond. So when you talk about bond, I'm sure that even perhaps as a novice or somebody who is uninitiated as far as the financial services sector or finance in general is concerned, would be knowing that when you invest in a bond, it is supposed to pay you certain interim cash flow, and at the end of the tenor of the uh, of the instrument, you're going to receive something known as the face value of the bond. All right. Now, the question is that something, let's say we are talking about a 5-year period. In general, we are taking this 5-year period in consideration. So if we are given certain numbers, for example, a bond is paying, let's say, 10% coupon. And at the 10% coupon mark, given the future promised cash flow, what should be the fair price of a bond at time t is equal to 0? If you're asked about this question, of course, you would know for a fact that you would require to discount all of these future cash flows in order to arrive at the present value at time t is equal to 0. You have to discount each one of them so that each one of them is present valued, and then you will add them all put together, and then that should be the fair value on the intrinsic value or the justified value of the security. And if the quoted price of the security, the market price of the security is favorable, then that would give us the datum level or the reference level to make our investment decision. Should we or should we not invest in the particular security? So Nevertheless, valuing a fixed income security or fixed income type of security, we require so we talked about the discounting, we talked about the future value, we talked about the interim cash flow, all of them. So of course, that has got to do, that is closely related to your time value method, time value of money methods, or time value of money related problems. Valuing a stock for the future dividends. Yes, stocks that pay future dividends, stocks that are actually historically known to be paying dividends, even they could be valued through the TVM methods as well. So, of course, there is an application of the TVM method in valuing the stock as well. And as you would know, that stock, unlike a fixed income security, may go through various levels and various regimes of growth. We could have a small time initial low growth period to perhaps a very high growth period for short duration, followed by a stable growth rate period, followed by perhaps a declining growth period as well. So that would depend upon the life cycle of the industry. That might also depend upon the lifestyle of the stock in consideration and all of those things. Even in those cases, all that we are talking about future cash flows or future projected or future expected cash flows. I'm going to denote this as ECF, right? The future expected cash flows. And then if you have got the notion of those future expected cash flow, all that we require is to suitably discount them to present value in order to find out the fair value of the security under consideration. So virtually, you could understand that regardless of the type of instruments, regardless of the type of financial securities, regardless of the time of the regardless of the type of the assets under consideration, so long uh, the asset is traded in the market or the security is traded in the market, and if there be some entering cash flow, even without entering cash flow as well, uh, but they should be traded in the market. If we have, then of course we can find the present value of this instruments, or should I say we can find out the estimated present value of these instruments and securities. All right, because in capital market there is no such thing as absolute value, absolutely right or absolutely wrong value. It's all an estimate that we are talking about, and your estimate might completely be different than what I would be perhaps estimating about a given security. We would also learn that how this is intricately related to something known as the implied required rate of return for a given security. Now, I know that some of the learnings out here, as has been depicted, they borrow heavily from the equity portion, or they borrow heavily from the derivatives or the fixed income, or even, for example, the portfolio mathematics, the portfolio management as well. But that's what CFA is gradually moving towards. They want all of the topic areas not to stand in isolation, but be fully integrated, so that as a candidate, you would know that a real life situation may not only be confined to a given security, but it would be entwined with other securities and other aspects and other techniques as well. So, enumerating stock or bonds implied rate of return, yes, TVM has an application there as well. Comparing securities bearing different notions, different qualities, characteristics, for example, a return, discount rate, tenor. So if we want to compare securities of such nature, for example, if you're given, let's say, three fixed income or three interest bearing securities, and I'm just making certain numbers. One is, let's say, paying uh, you know uh, uh, one is paying, let's say, a 10% semi-annual coupon, 10% semi-annual coupon, and its tenor is for the next 2 years. And this bond perhaps is rated as triple B plus. The next bond I'm talking about is, let's say, a bond that pays, let's say, 12% annualized coupon. That means only one coupon a year, and the duration of that is only about a year is left. This bond is rated, let's say, again, double B, triple B plus. Let's say this bond is also rated triple B plus. And the third bond I'm talking about, let's say we're talking about a bond that pays a coupon of 8% annual coupon, but that is due for another 5 years, and the rating is double A plus. So if you were to actually compare the bonds, all other things remaining constant, if you were to only pick up one of these instruments as your probable investments for the foreseeable future, which one would you go for? So if we have to do such apple to apple comparison, or should I say apple to oranges comparison, so of course you would know that time value of money is going to play a very big role in that. All right. So the last but not the least is that time value of money also helps us in spotting mispricing opportunities, mispricing and arbitrage opportunities by comparing an asset's value, the intrinsic value, fair value, and the market observed values. More prevalent in arbitrage opportunities are where same asset trading at two different values in two different markets at the same time. So those are the myriad applications of time value of money, and we're going to learn each one of them piecemeal out here. All right. So as I've stated before, and I want you to pause this portion of the video because this is very, very important. This is exactly the way our tutorial and our lesson is going to shape up. So please pause this portion of the video. I've already discussed about it. Not going to waste my time. Read through the disclaimer. This is how it is exactly going to be. And a note of caution to all of you: should you want a detailed tutorial about the TIBA2 Plus and a TIBA2 Plus Professional, I would strongly implore all of you to go through my free YouTube lectures that's there on my channel. And should you want, then you could perhaps ask me as well. I will provide the link to all of you. I have got a detailed 2-part 3 hours tutorial I've done on each and every function possible on the BA2 Plus calculator. And for the ones who are starting their journey, it's a must watch. Let me assure you that 50% of what we are going to study as part of your quants, the basics ones, as at least at that, they're going to be completely clear once you go through the calculator tutorial, because there's no theory, right? All that we are doing is keying in number in the real time, and proving each of the functions, making use of each of these functions, just establishing the validity of this particular calculator. All right. So let's rehash from a previous learning as well, from our previous chapter as well, the relationship between the present and the future values. So all that we have stated is that any asset or any security, let's say any asset or any security that is trading in the market, so one of these two things would be right. Okay, one is that this asset or this security, let it be a bond, let it be an equity, or you could think of any other financial securities as well. So either they are going to be an interim cash flow or not. So for example, let's say our holding period is, or horizon, should I say, our horizon is 5 years. All right. So for this 5 years, I may have a choice to invest into securities that pay annual, let's say annual dividends. So we are talking about, let's say, a couple of stocks, one that pays annual dividend and another that does not. So the one that does not, of course, you can understand that I'll be holding it today with the view of a huge capital appreciation, right? So that is going to be my expectation. Otherwise, this security does not make sense to me. So if I'm investing, let's say $100 out here, and I'm just making certain numbers, please don't hold me in the, please don't quote me otherwise. But let's say this 100, my expectation is that 5 years down the line, this should at least be 300. All right, so that's my internal estimate. That's my internal calculation. I have had some logic, some hunch, some notion, whatever you want to term it. At the same time, I have a choice of actually investing into another security that pays that pays a healthy dividend of, let's say, $20 every year. Okay, it pays $20 of coupon, $20 of dividend every year, and given my 5-year horizon, I'm expecting maybe if I invest 100 out here, I'll be able to exit around, let's say, 200 at the end of 5 years. So these are simply estimates. So in this case, let me just put such nomenclature in and around this. So the 100 that we are talking about here, this is what we are going to be calling as the present value or our initial investment. And the exit value that we were talking about, that is what we are going to term them as the future value. Okay. And the interim cash flows out here in our calculator, in our TIB, in our BA2 Plus and BA2 Plus Professional calculator, those interim dividends that we are talking about at each of this timestamp, we are going to term those dividends as PMT. PMT stands for payment, of course, as you would know. All right. And as you would be knowing that the relationship between the future value and the present value, of course, is that the future value is nothing but the present value being compounded. Okay. The present value being compounded at a certain rate. Okay, so this particular rate that we are talking about, if we do a simple transposition, we would say that the present value then should be connected to the future value by when we discount the future value at this particular rate. Okay, and if you recall anything from the previous chapter, as I've stated that when you multiply the 1 plus r with the present value, we call them the compounding rate, and then when we use the same compounding rate to deduce the present value from the given future value, we call them the discounting rate. Now, a word of caution, and as before, the compounding and the discounting rate seldom are the same, because if they're same, then obviously we are talking about a future value is equal to present value. That can only happen if you're talking about a risk-free security. Other than that, the compounding rate and the discounting rate are always going to be different. All right, so this I hope is thoroughly clear with all of you. We have already done this. We already know the difference between the discrete compounding and that of the continuous compounding as well. All right. So in case of the, let's say, the present value out here, if I'm allowed to actually expand this a little more, then the present value can look like, because there are certain cash flows, right? Let's take this particular example itself, the one that pays you dividend. So if I have to actually expand on the right-hand side of this particular equation, then I'm going to write, because in the timestamp t, I'm going to receive a dividend. So let's call this a D1. So D1 is going to be discounted for one period. Similarly, in the next period, I'm going to get a D2. Again, this is going to be discounted for 2 period, because this is 2 period ahead. All right. And the third one is going to be discounted D3, one they are for 3 period. And the fourth one, of course, is easy. It is going to be 4 period. And the fifth one is, of course, wherein we have the D4 plus the exit value, which we are estimating to be some value. So I'm going to put this as FV discounted by 5 periods. So when you add all of them, that is where you should, what we get is the fair value of the present value. All right. So these relationships should be deeply embedded in you. That's all that I'm saying. Okay. This is the discrete term. This is the continuous term. So let's solve a few problems. And as I said, that this chapter is best understood if we solve through the problem rather than me trying to explain, because I think and I've seen that solving the problem directly on the board does the job much better than actually me doing a monologue. All right. So we got the UK bond strip provided. Don't ask me what this strip means. Of course, we are not referring to any club. This is a separately traded registered investment product. That's the short form of long form of strip. A UK government bond strip provides a payout of £100 in 10 years. If an investor expects 5% return with annual compounding, what should they be willing to invest in this security? In other words, what this says is that this is a zero coupon bond, and the investor is like, the bond is going to mature 5 years down the line. The bond has been issued today. Let's assume it has been issued today. It's a zero coupon bond. So somebody should be investing in this security with the expectation and hope that at the end of the term, at maturity, the investor is going to receive a lump sum amount. Now, that lump sum amount has been given to be pound 100, and the likely discount rate has been given to be 5%. Now, given these two, and we already know that the time period is 5 years, so given these three, we have to find out that what should be the fair value of the security. And that is the reason that they say that what should the investor be paying for this at the most? All right. So how do we do that? Absolutely easy. It should be intuitively clear to all of you that since all of this is given, all that we require to do is to find out the present value. Now, pertaining to this particular problem, you could do it directly. All that you require is discount this 100 by 1 plus 5% for a period of, okay, sorry, it's 10 years. My mistake. It's 10 year. So 1 plus 5% to the power 10. So we discount this. So if you discount this, so all that you're going to get is around 61.31. And this is the fair value of the security. In other words, if you're getting the security, if the at less than 61.39 given the market condition, you would actually be better off because you would be you are buying a security which is cheaper than that is trading cheaper than its fair value or its intrinsic value. Let's see how things do change. If the same bond under consideration pays a semi-annual coupon. All right, so out here, then we have this 20 periods, of course. Why 20 periods? Because semi-annual compounding. And the other details that are being given, let me just enumerate them. So the face value or the future value out here is going to be 100. And in case of bond, it's always the case unless otherwise mentioned. So do not forget that. The coupon that's being paid, I'm going to denote this as PMT, that is being paid is given as 1.75. Why we are saying 1.75? Because it's a semi-annual coupon of 3.5%. As stated before, that unless otherwise mentioned, interest rates are always annualized. So that means every 6 months, we're going to pay 3.5% divided by 2, which happens to be 1.75%. So 1.75% of £100 face value. Always do remember that the coupons of a bond are always calculated on the face value of the security. All right. So the face value pertaining to the face value of the security, it's going to be £1.75. The number of periods as you would already know, is going to be 20. How is it so? Because it is 10 years and every 6 months you're getting coupon. So there are 20 coupon paying periods. And now all that we require is the discount rate, which in case of bond, we call them the yield. So the yield out here, and I'm going to denote this as I by Y, is going to be 2%. Why it is going to be 2%? Because it is again semi-annual. So there has to be consistency. If your coupon is semi-annually paid at 3.5%, which becomes 1.7%, so your annual yield also will become proportionately 2% in place of 4% every 6 months. Now, do we write this entire 20 coupons and do the calculation? Because if we do that, of course, within 90 seconds, it is going to be impossible to solve the math in your exam, and neither it is elegant, right? And that is exactly where our calculator comes to rescue. All right, so this is not possible. That's all I'm saying, that if you go on doing this and manually, if you do go on calculating this, it's never going to yield the result. So how do we do it? So what I want you to do is open your TI, do a BA2 plus calculator or BA2 plus professional calculator, whatever version that you have, and follow the syntax. First and foremost, press your second button and press your FV button. On the above FV button, there is something called as CLR TVM, that is clear TVM. Why we need to press this every time? Because you need to ensure that the memory is completely clean. You don't want any of the remnant of any of the previous problems that were being solved in your calculator, and you forgot to actually clear the memory. So in order to avoid that, always as a hygiene, do practice this, that second TV, clear TV, and second FV, and then again press CEC. Okay. When you do this 2 steps, it's going to ensure that you're completely memoryless. There are no remnant. There's no reminiscence inside the calculator that may otherwise contaminate your working and the final result. Now, all that you have to do is to key in each of these details, the given figures one by one, and then ask the calculator to give you the value. All right. So which are the details that's there? We have got the face value. So I want you to, simple as has been written here, press 100, and then press FV. Okay. Press 100 and press FV. Second, press 20 and press N. If you want, you can use the button enter as well. That's going to doubly ensure that all the values that you're keying in are actually being stored in the desired function. All right, and then press the yield, that is 2, and then press I by Y. I by Y is the interest per period, which in our case happens to be the discount rate or the yield. All right, so now we have 20 to, yes, we have done everything that we could. Then all that is required is your payment. Coupon is 1.75, so press 1.75 and press the PMT button. All right. So now in the TVM worksheet, always remember there are 5 variables. In these 5 variables, if you input any 4, the CalC is going to give you the 5th value. In this case, the 5th value happens to be finding out the present value or the fair value of the security. So after you have keyed all in, I want you to press CPT and press the PV value. And once you do that, you're going to get a PV value of 95.912 with a negative sign. The negative sign indicates, always do remember that the calculator treats something as cash inflows against which the cash outflows can be measured. You can't have a yield without an investment, right? So in order to maintain that sanctity, one of them is always going to be, if you're investing, so you're initially, it is a cash outflow. The cash outflows are going to be shown with the preceded with a negative sign. Always do remember this. And in other circumstances, when you have actually borrowing something, so in that case, there is cash inflow that is happening. In that case, of course, the PV will come with a positive sign, and an FV obviously is going to come with a negative sign. All right. So I hope that you would understand. That's common sense. All right. So now from here, let's boil down to a problem. And I read, an investor seeks a fixed rate 30-year loan mortgage to finance 80% of the purchase price of $1 million for a residential building. Mind you, this is a problem that I've picked up from the text itself. All right. Residential building. Calculate the investor's monthly payment if the annual mortgage rate is 5.2%. So let's do it. Let's understand that 30-year, of course. Let's just draw the timelines. Always draw the timelines. It's going to ease up your world. And let's assume that this is first year. So with first year, of course, there are 12 months. All that is required is for us to find out the monthly level payment against a fixed interest. It's being assumed that the rate of interest that is being charged to this borrower is fixed for 30 years. Seldom it happens, but in this case, for our learning purposes, it is being assumed that it's fixed at 5.25%. 5.25% annual. All right. So let's understand. So in this case, what's happening is you're borrowing, right? You're borrowing 80% of the $1 million, which means you're going to borrow today at time t is equal to 0, $800,000 you're going to borrow. All right. And then you have how many periods? You're going to have 30 into 12. That is 360 periods. 360 periods would mean 360 months. And each of this period, the interest rate the bank is going to charge is going to be equal to 5.25%. That's annual. We'll have to divide this by 12 because it's a monthly rest. So I want you to divide it by 12. So the interest rate per month happens to be 0.437%, 0.4375%. You could round it up to 0.437. That's absolutely all right. Okay. So all that's being asked is, now at the end of the tenor, of course, you're going to retire the loan. Once you retire the loan, of course, the balance is going to be zero. So now we have fed in the present value of the cash inflow, the tenor, the discount rate that's going to be applicable, the future value or the face value in this case at the end of the tenor, which obviously happens to be zero because by the year end 30, you would have retired the loan. All that has been asked for us is to calculate what's going to be the monthly level payment. Okay, so what is going to be the monthly level payment, which in our case, we are going to denote this by the PMT button. All right. So again, the reason that I'm walking you through this particular direction is because I don't want you to memorize, plethora of formulas. Your CFA text is riddled, your book is riddled with useless formulas. Most of those formulas are never required. As I said before multiple times, at least in your level one, and why level one? Across all the three levels of your CFA, you really would not require 80% to 90% of those formulas. If you understand the underlying principle, the underlying math, if you know how to actually run your calculator, there's no need to memorize any of the formulas. So I'm not going to bore you. I'm not going to overwhelm you with the memorization part of any formula. No, that's not the objective at all. If you know how to run your calculator, that's going to do your job. All right. So let's just key in the detail. That's all I'm saying. So I'm also simultaneously doing along with you. It's not that I'm just keeping myself aloof from this. All right. So we've got the I by Y. We've got the present value. We've got the future value that's going to be. We've got the tenor. So we have fetched all of them. All that I'm asking the calculator is to give me all right. All right. So if you do the math, I think just a sec. I'm not sure what's happened. 800. All right, sorry. So I missed out with the zero. Okay. My apologies. So if you do the math correctly, if you feed in all of this data and ask your calculator to CPT stands for compute the monthly payment, PMT, the calculator is going to throw you the value of minus, it is going to proceed with minus depicting the cash outflow, 4417.62. We are going to round this up to 444418. So $4,418 US dollar, that is going to be the monthly rest payment for the mortgage borrower. All right, so that's settled. All right. What is the principal amortization and interest breakdown of the first two monthly cash flows? Now, this is where things would get interesting. Why is it so? Again, you could do it. You could do it. What is the principal amount and interest breakdown of the first two monthly cash flows? So let's understand what they're saying. Is we are talking about the opening balance, and the opening balance is let's create a certain column. So we have the opening balance. So we have the interest payment on the opening balance, interest payment on the opening balance. And of course, we have the level paying payment, level payment, level payment. And of course, as you would know that the particular level payment, let's also call this level payment. You could also term this as EMI. At least in India, we call them the EMI, or the equated monthly installment. So this equated monthly installment or level payment, they're one and the same thing, will always have a couple of components. One is towards the interest and another is towards the principal payment. So of course, let's segregate those cash flows. Oops, my bad, my bad. Principal repayment and the ending balance. Okay. And here we are going to put the period. All right. So which period we are talking about? Of course, we have the 0th period. We have, in the 0th period, the ending balance is always going to be plus 800, which happens to be the opening balance for period 1. That will always be the case. The ending balance of a period is always going to be the opening balance of the period following the same. So this is the opening balance, the interest payment. Now let's first talk about let's focus upon this particular column. That's the level payment. And as we've already known that the level payment is 4417.62, 4417.62. This is the level payment. Okay. And the interest rate is at the rate of 0.4375. This is the rate of interest that's there. All right. So how do we go about it? We are being asked to calculate the principal amortization and interest breakdown of the first 2 monthly cash flows. Principal amortization and interest breakdown of the first 2 cash flows. So it should be easy. The first one, of course, you have got taken a loan of 800,000. So the interest that is going to be applied on this is going to be 0.4375. That's a monthly rest interest. So let's work it out. So this happens to be 3,500. All right. So we've got the level payment as 4,417.62, of which 3,500 is only going to go towards serving the interest of the loan that's there, which means that the rest of the money is going to go to meet the outstanding loan demand, which in this case happens to be 917.62, which means your ending balance is going to be your ending balance is going to be 799 $1,082.38. Okay, I hope you understand how I have done this. So first we took the initial opening balance. Since this is monthly rest payment, we already are aware that regardless of the month, this is always going to be the payment. This is going to be the payment till the 360th period. Okay, make no mistake. This is the level payment at the rate of 5.25% interest annually calculated, of course. This is what the monthly level paying payment is going to be, of which, of course, the first month, you're going to go to the interest of 3,500. How do we do that? Because we have already calculated the monthly interest rate happens to be 0.4375%. So if we simply calculate that, it is going to go to 3,500. And the principal payment obviously is going to be the balance or the net figure or the plug figure of the plug figure between the level payment and the interest that is being paid. Remember, in case of mortgage, in case of any loan, the interest payment will first take the precedent. Okay. Now, the next month, what would happen is that this would serve as the opening balance of the loan, that is 799,082.38. This happens to be the opening loan balance. And we are going to calculate the interest on this particular loan balance. And now your interest payment is going to be 3,495.98. And I'm going to roughly, just for the calculation's sake, I could roughly round it up to 3,496. All right, which tells us that the balance that is going to go towards meeting the principal repayment is going to be 921.634. 921.634, which tells us that the closing balance of this loan is going to be 798 160.74. This is going to be the ending balance after the second month, which of course is going to serve as the opening balance for the month number 3. And this process will go on till the 360th month, assuming that there is no default. The ending balance at the end of the 360th period is going to be obviously 0. All right, so our question had actually asked us to calculate the principal amortization and the interest breakdown for the first 2 monthly cash flows, and these are the answers. So if we break down the amortization part, we will see that the principal payment for the first month is going to be 917.62 US dollar, and in the second month it happens to be 921.634 US dollar, and the interest payment for the first month happens to be 3,500. The interest payment for the next month happens to be 3,496. Now there is an interesting thing. So first and foremost is that there is a typicality of this amortization schedule. And this amortization schedule is, and the typicality is that as we proceed, you would progressively see the interest portion being reduced with every passing month. It will come down gradually initially, but after a certain time, it would accelerate. And the reverse would happen as far as the principal payment is concerned. The initial principal payment is going to be minuscule, but as we progress, we'll see rapidly after a certain point in time, the principal payment is going to be much more. It will become big in number. Okay, what does that mean? So I'm going to illustrate this with some cool graphics, some cool rendition, if you would want. So let's assume that this is my level payment. Okay, so this is my month number 1 level payment. This is my month number 2 level payment. And let's say this is my month number 100 level payment. This is, let's say, 20th level payment, 200th level payment, EMI. And let's say this is having my uh, the 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 ultimate level paying period. So we've got the first period, we've got the second period, we've got the 100th period, we've got the 200th period, and this happens to be the 360th period. All right, so if this is the case, then I want you to understand that this entire bucket, each of this bucket is still your 4,417.62 dollar only. Okay, each of this bucket is that. There is no difference. However, the content of the bucket, of course, that shifts humongously. So initially, let me tell you, the one that's shaded in red, you could liken this to the interest payment. Okay, and the one that's left unscathed, let's paint them in green. This is my principal payment. Okay, so what happens is that this is my interest payment. This portion is my interest payment for the first year, and this portion is my principal payment. In the second month, the same process repeats. However, now there is a slight difference. And the difference is watch how the principal portion being paid in the month number 2 is slightly more than the principal portion being repaid in month number 1. And this will always be the case. This is always going to be the case. This portion is interest payment, and this portion is your principal repayment. Okay, this is your principal repayment. Now, as we progress along the time scale, let's take for instance the month 100. Out here, you would see that almost close to half of the portion of the monthly level paying payment is going to serve the interest, while the rest of them is going to serve the principal. Okay. All right. So by the end of the 200th month, things would start reversing. You see a large portion of the monthly payment actually goes on to meet the principal, retiring the principal, whereas some portion still goes to serve the interest. And what would happen at the 360th month? Yes, you've guessed it right. This entire bucket is going to meet the principal. And this is precisely how your amortization schedule actually works. Okay, now one big question. This is fine as far as the first couple of months is concerned. You may actually work through the first couple of months in this manner. However, given this, of course, you can understand that this is definitely a task in itself, isn't it? Let me just hold on. I'm working something on my calculator. All right. So, yep. Now, what if okay. Now, if you want to work this way, of course, I was stated before that this is going to actually consume a lot of time, because you'll have to segregate first each of these periods, and then the opening balance, then the interest payment, and then the level. Each of these things you'll have to write separately and then work through this. If it is for the first couple of months, even if it is workable, it's going to obviously consume more than 90 seconds of the allotted time. What if I can tell you that there is an elegant shortcut that exists in your calculator, in your TI BA2 plus calculator, that will, once you've got the level paying payment, this portion is something that you've already worked through. Once you've got this, then the rest of this amortization schedule or the amortization worksheet that I've just depicted out here, this is my amortization schedule. This can be actually worked for any given month in a fraction of a second. You'd love to learn that, right? So all that I want you to do, once you have got this level payment, I want you to press Calc CEC so that you come out of this worksheet completely. Come out of the worksheet, okay? So, and then press the button second, and then press the button amort. Press the button amort, which is PV, okay? Which is PV. I want you to press the button amort. All right, so I'm also doing along with you. And the moment you do so, you will see that there is a P1 button, and the default value of P1 is going to be 1. I want you to pay attention to this. Leave it as it is, especially for this problem, and then press the down key. You're going to come to P2. I do not know what the value of the P2 would be in default in your calculator, but still, if it is anything other than 1, I want you to key in 1 once again. Okay, so once you key in, but then press the down key once again. If you press the down key, then you're going to get something known as BAL. BAL happens to be the loan balance, and the loan balance is going to show you $799,082.37, exactly this particular figure which you have derived after this calculation measure. Okay, so you've got the first notion that how your calculator is already working behind the shadow. Okay, it's already calculated that. You don't have to do anything. You just have to find the right key to press on. And now please keep on pressing the down key once again. If you press the down key, you're going to get a value known as PRN, which tells you the principal repayment, and the principal repayment happened on month number 1. It is going to show you a value of 917.63 with a negative sign, of course, depicting the cash outflow, which obviously is this value. All right. And then I want you to press the down key once again. If you press the down key once again, you're going to get the INT, and the INT happens to be 3,500, which happens to be this value. Okay. Now, if you press the down key once again, you are going to default to P1 again, wherein the value is given as 1. Now, this time around, what I want you to do is to press the value 2. Instead of 1, press the value 2 and press enter. So P1 becomes 2. Press the down key once again, and P2 value is going to be, by default, it is still going to show 1. I want you to press 2 and press enter once again. All right, so you press button 2 and press enter once again. And now I want you to repeat the exercise by pressing the down keys. If you press the down key once again, you're going to get exactly the value of $798,160 as the balance loan outstanding. Press the down key once again, you're going to get the principal repayment of $921.634. And then press the down key once again, you're going to show it, the calculator is going to show you the value of the interest payment as 3,496. Okay, what did I do? Nothing. I just keyed in the values of month number 1 and month number 2 as has been asked as part of the amortization schedule, and the rest of the job is being done by calculator without me actually moving an inch. All right, so we spent considerable amount of time. I think we already have spent more than 20 minutes on this particular problem. But the reason, as I said at the beginning of the chapter itself, that this chapter is all about practice and doing the work, getting your hands dirty, rather than me actually explaining through some words. That's never going to work. And this is the beauty of it. This is the beauty of your TIBA2 plus calculator, because it lets you do complex mathematics, complex financial mathematics, work through them in a very elegant and time-saving, efficient manner. Now, you would be wondering that what if the amortization schedule is being asked? It is true for the month number 1 and month number 2, but what if I ask you what is going to be the amortization schedule on the 350th month and the 351st month, or let's say 360th month? Can we do that? Of course we can do that. What do you have to do? All that you have to do is to properly key in the P1 and the P2 values. If you want the amortization schedule only for a month, it does not matter whether you're pressing in the first month or the second month. You just need to ensure that the sequence is right between P1 and P2. The sequence between P1 and P2 is more important rather than which period's amortization schedule you're actually asking. That's the only trick that you need to remember. All right, so let's just do it for out here. Again, I press the second amort button, and then instead of 2, I want you to press 350, press the down key once again and press the 350. All that it's saying is that I'm interested in finding out the amortization schedule at the end of the 350th month. And all that I'm required to do is to press the down key at will. The first is going to show the balance. The balance it is going to throw up around 43,131. That means after 350th month, the principal outstanding of the 800,000 loan that has been taken is now left with 43,131. Press the down key once again, of which the interest, the principals that's being retired so far is going to be 755.950. Of course, that's very easy to understand because 800,000 loan you have taken from that. If you pay 43,131, if the 43,131 is balanced, that means 755,950 has already been paid off. Press the down key once again. Press the down key once again, and the interest balance is going to show that you have paid an interest of so far cumulatively 785,802. This is your interest payment cumulatively. I'm sorry, we could do it cumulatively as well, but okay, we wanted to exclusively find out for uh, uh, 350th month, right? So let's do it here. If we are exclusively asking for the 350th month amortization, so we could key in P1 as 350 and press the down key. You're going to get P2. Please key in 350 once again. Okay. So that means it is going to in particular show you the 350th month beginning and 350th month ending for only 1 month period. Do not forget to close in, feed the data correctly. P1 and P2, feeding in and keying in P1 and P2 is the trick to this whole thing. All right. So now that we've done, now if you press the down key, the balance it is going to show you is 43,131.6. Well, this is, of course, the principal outstanding of the loan balance. And of the EMI or the level payment of 4,418, 4,210 in the 350th month is going to go towards meeting the principal payment on this particular month, and only 207 is going to go towards meeting the interest. All right. Okay. And if you want to repeat the exercise for the 350th month, you could do that again. All that you need to do is to change the figure from 350 to 351, enter the values accordingly, and then just keep on pressing the down key. It is going to show you a balance now, a new balance of 38,902.7 is going to show you as the new balance loan outstanding. The principal being paid in on the 351st month happens to be 4,229. I simply rounded it up, and the interest that's being paid is only going to be 188.7. All right, so this is what your whole worksheet is going to be like. You could play around with as many months as you want. Just ensure to key in the right value of P1s and P2s, and the rest of the work, the calculator will do it for itself. All right. So from here, now let's move to something known as the annuity. All right. And I read out, I think if you're receiving or if you're paying a fixed sum of money forever, that is what is known as annuity. It could be on a finite interval, for a finite interval as well, for a finite time period, or it could be even infinite time period as well. Remember, when we're talking about the time periods, We are talking about a fixed amount, and we are not talking about a year in particular. A time period could be a month, a week, 7 days, every day, a year, does not matter. But all that I am saying is that to maintain the consistency and uniformity, if you specify the cash outflows or the cash inflows periodically spaced every week, every day, also that also can be termed as an annuity. Or if you're talking about a year, one payment, that means only one payment each year is to be considered, that also can be termed as annuity. All right, so there is a difference between regular annuity and annuity due. All that is said is that you just need to understand that, let's say we are talking about two time period, t is equal to 0, t is equal to 1, and t is equal to 2, two time period. Whenever we are talking about a regular ordinary annuity, we always consider the cash inflows or the outflows happening by default at the end of the first year, at the end of the first year, at the end of the second year. That means at the end of the period. Okay. When we are talking about annuity due, when we are talking about annuity due, we are talking about cash flows or cash inflows or outflows. The cash flows are happening at the beginning of the period, at the beginning of the period. So what's the logic? The logic is the same cash flows we are talking about, whether cash inflows or outflow does not matter, but the periodicity only differs in its terminology. Regular, ordinary annuity, or annuity in particular, would mean cash flow happening at the end of the period. Whereas specifically when we talk about annuity due, that means the cash flows are happening at the beginning of the period. Which kind of cash flows can happen at the beginning of the period? Monthly rent, lease, yes. Magazine subscription, yes. Any sort of club membership, yes. All right. So this is where we differentiate between the two. Now, what implication does it have? It will have certain implication, of course, because when we arrive at certain finite value while valuing an annuity or the loan due, whichever way we want to call it, so that particular point in time, we might feel the difference. But the point being that uh, should we try and memorize this ugly looking formula that is appearing? The only reason that I'm writing this formula is because your text actually mentions it. Other than that, as I said, if you know your calculator well, you need not memorize any of the formula that's there. All that you need to do is to understand how to work through the TVM worksheets. There are a few worksheets on TVM. All that you need to do is to familiarize yourself with those worksheets, and that's it. For example, let me just walk you through one of the examples. Emily invests $100,000 each year for the next 2 years at 14%, starting in 1 year. How much will she have at the end of the 2 years? Well, this is again one of the annuities. You'd know that, if 100,000 is being invested, so she's going to receive the first interest out here and the second interest out here. Excuse me. So at the end of 2 years, it's obviously going to be 100,000 into 1 plus 14%, because 14% is being stated to the power square. This is going to be the result, right? Oh, I'm sorry. Yeah, so this is for the first cash flow. Emily invests this money each year. So this is the first cash flow, and then this is the second cash flow. So the first cash flow is going to work for 2 years. The second cash flow obviously is going to work only for 1 year. All right. So the future value is going to be a big summation of all of them, right? Big summation of all of them. And if you do that, obviously you're going to get certain result out of it. And that result, if you put in the formula out here, as has been stated, 100,000 into 1 plus 14% to the power 2 minus 1 divided by 14%. If you do that, whatever value you get, you're going to get the same value out here as well. But my question out here is that should we, as a financial analyst, as a budding potential financial analyst, should we be resorting to this kind of manual calculation? And the answer is no, we should not. We must find, and if there is any, a much more elegant way of solving the problem. So in this case, since this is a level payment that's happening, $100,000 is being invested each year, uh, you could use the TVM worksheet once again. Yes, you've guessed it right. What do you have to do? We have to key in the values appropriately. All right. So in this case, you press second and press the clear TVM button, second, and the arrow button that's there, that's clear TVM. And I also, as I said, that press second and press CC so that your entire memory is erased and your worksheet is fresh. Now what I want you to do is to press second once again. Okay, you've already pressed it. So now what I want you to do is to key in the value. So she's paying $100,000. So I want you to write 100,000 and then press the plus minus button. That's important because you need to precede it with a negative sign. That is a cash outflow that is happening. And then I want you to press the PMT button. So once you press the PMT button, that denotes the regular cash, the regular investment that's happening at a specific interval of 1 year each. All right, and then press N. That means it is happening for 2 years. You did not have any other value at the beginning, so press 0, press PV. You did not start anything because you're paying at the end of the year. So press 0, press PV. And the compounding rate, understand and see how my language changes. Now I'm no longer talking about discounting it because this is investing. So when you're investing, you should use the word compounding, and your compounding rate has been given as 14%. So I want you to write 14 and then press I by Y and press enter. Write 14, press I by Y and press enter. Once you've done that, that means you've correctly fed all the 4 values. You've pressed the periodic payments, you press the periods, number of periods, you press the present value and the interest rate. All that you want the calculator to give you the future value of this entire yield. So press the button CPT and press FV. Press the button CPT and press FV, and you're going to get a value of $214,000. And I'm sure that if you work through this manually as well, you're going to get the same value at $214,000 out here, as well as out here as out here as well. Okay, so I'm sure that this is clumsy. This memorization is not required. Elegantly working through the TVM worksheet is smart work. Now let's see. Let's just reverse the problem. It says that Emily expects to receive 100,000 each year for 2 years, starting in 1 year. And your opportunity cost is 14%. How much is it worth today? So the out here, it was cash outflow that was happening as far as Emily was concerned, because she was paying in 100,000 each year at the end of the year for 2 years. Okay. In this case, it's just flipped on its side. And all that is being said is that instead of she investing, she is a recipient of this regular annuity, and the regular annuity happens to be this much. So if she were to take advantage of this, invest in this regular annuity, wherein she's going to receive 100,000, what is going to be the present value of this investment? What is going to be the worth of the present value? And as before, do we want to do with this ugly looking formula? I guess not. But just that your text mentions Hence, I have to write it here once and forget about it. The rest of the thing is going to be easy. All that we have to do is press seconds and press clear button. Okay, as stated before, clear your worksheet, clear your CEC, and now start keying in the values. Okay, write 100,000, write 100,000. Now leave it with the plus sign only and press PMT. Okay, now you should be thorough with this. Since you expect to receive only for 2 years, so the future value, there is no lump sum redemption that's happening. You have to calculate the present value of this investment. All right. So 4 data are being given. You can key in this 4 data and ask your calculator to give you the value. And the calculator is going to throw you a value of 164,666.05. Let's just keep it at 164,000. US dollar 164,666. This is the investment Emily is required to do today in order to receive 100,000 each year for the next couple of years. All right. So again, the same result, more laborious ways. Annuity due. Annuity due, as we have stated before, that it is the beginning of the period cash inflows or outflows that is being actually taken into consideration. We could work through certain example as far as annuity due is concerned as well, but I like this particular formula. There is again certain elegant shortcuts that exist in your calculator, wherein you could calculate the annuity due, by manipulating the keys in the calculator itself, manipulating the worksheet. But I think that instead of going that route, this is better. Now let's first understand the problem. So what is meant by annuity due? You remember the last couple of problems that we did. In each of these problems, the cash flows were happening at the end of the year. Okay, and either the lump sum value were required to be found out or the present value were required to be found out. But the cash flows indeed were happening at the end of the year. Now, what happens if the same cash flows, whether it's cash inflows or outflows, instead of the beginning of at the end of the year, is required to be done at the beginning of year itself? Okay, so all that I'm saying is that instead of making the investment out here, oops, I'm sorry, there is one mistake now. I remember I did. Okay, so this is one mistake. It should not be 2. This is 1. And then this should be 0. This is in fact the annuity due kind of thing which we did. Okay. Okay. So let's imagine the same investor investing same $100,000, but this time around, instead of at the beginning of the year, at the end of the year, and she makes the investment at the beginning of the year. So she makes an investment of $100,000 out here at the beginning of the year itself, and then another $100,000 at the beginning of the second year itself. So what is going to be the lump sum that she should receive at the end of the year? At the end of the year number 2. All right. So one way of looking at this is that the previous problem that we did, wherein we found out the future value, which happens to be 214,000. All that we need to do is just calculate this 214,000, multiplied this by 1.14 once again. Why 1.14? Because the ordinary annuity, wherein the annuity is actually being taken care of at the end of the year, instead of that, now what we are doing is we are making the annuity calculation at the beginning of the year itself. So in order to find out the future value of such investments wherein the investment is being made at the beginning of the year instead of the end of the year, all that we need to do is to first just ignore that as if the ignore uh, ignore the fact that it's being invested at the beginning of the year itself. We can assume that it's happening just like an ordinary annuity at the end of the year. And then whatever value that we get, we just need to multiply this one more time with the periodic interest. In this case, our periodic interest, for example, happens to be 14%. So if we do that, we're going to get a value out here as 214,000 multiplied by 1.14, and this should be equal to 243,960. How this happens to be 243,960, let me just graphically first present to you so that intuitively you also understand. See, the first cash flows is now going to work for 2 years. Year number 1, it is going to work, and it is also going to work for year number 2. So the first cash flows contribution to the future value happens to be 100,000 multiplied by 1 plus 14% to the power 2, plus the next cash flow, which is happening at the end of at the beginning of the second year, is going to work only for 1 more year. So it's going to work for 1 more year. Okay. So if you add this, then you're going to get the future cash flows, FVCF, future value of the cash flows, as equal to 243,960. This happens to be the future cash flows. Okay. This is exactly identical to what we have found out here. The only difference is this is the manual way of doing the whole stuff, laborious. This is where you just treat this as an ordinary annuity and, excuse me, multiply this. Now, the question is there a shortcut that exists in your calculator wherein you could do the same job but in an elegant way? The answer to that is yes, we could do that. But for that, you will need to change your calculator setting. Uh, I don't want explicitly this chapter to be of calculator tutorial because, as I said, that I've made separate videos towards calculator. But since we are in the topic, let me just flow along with the concept and let this be one of the last times wherein actually I'm going to impress upon the shortcuts of the calculator. So all that you need to do is to press second, okay, and press the PMT button. Of course, before you do so, please clear your memory. And I'm not going to tell you how to do that. You would already know that. Once you do this, your calculator is going to show you a value of END. All that I need you to do is to press enter now. Once you press enter, you will see the END value has changed to BGN. Once you get the value BGN, then I want you to press second and press CPT. Okay, that means you have now come out of the worksheet. But now you're telling the calculator, you will see that the BGN sign is now going to appear at the right-hand side of your screen in the calculator. That means you are explicitly telling your calculator the cash flows now you're going to feed in the calculator. The calculator must consider these cash flows as the beginning of the period itself instead of the end of the period. Okay, so if you do that, rest of the thing is all about feeding in the values as they were. 100,000 value, I need you to feed the value in the same manner. And press the CPT FV, just like an ordinary annuity that you saw. And your calculator is again going to return the value of 243,960. So we see that all these three methods of calculating the annuity due when the cash flows have to be made at the beginning of the year, either inflow or outflow, all these three methods are going to yield you the identical result. But of this, I like this particular one the best. Why is it so? Because first and foremost, this is laborious. So to be discarded, we need to be smart in our working. Second is with the calculator, please do understand that even though for me as a seasoned professional, doing this requires certain keystroke, mastering those keystrokes, and thereafter remembering that once I'm done, I need to come out of this. Okay. I need to come out of this situation, which means I'll have to recalibrate my whole calculator and let the calculator know that once the work is finished, I have to remove the BGN. From the BGN, I'll have to go back to the END format in the calculator itself. Because if I don't do, what would happen is that the next few problems that I'm going to do is going to be disastrous. And that is exactly where the potential mistake lies, because candidates at times actually do forget to change the setting on the BGN mode in the calculator. Once they've done that, if you simply exit the sheet as it like just like that, your calculator is now going to consider each of the values going forward as if you are actually considering them from the beginning of the year itself. You don't want that. Okay, so that means you'll have to change the setting. You'll have to remember to change the setting. I don't want you to do that either. The simplest way to simply calculate the annuity as you would and simply multiply them by 1 plus periodic interest. All right. So now we are talking about perpetuity. Uh, Paying or receiving an equal sum of money at equally spaced out intervals forever is perpetuity. Perpetuity is geometric series. So the present value is derived by summing up the cash flows at infinite geometric progression. For example, let's just take this example. A company is paying a constant dividend of 4. The required return is 10%. How much should you pay for the dog? So it is as good as saying that if you're receiving $100 a year from a bank, and this continues forever, how much actually you put in the bank as part of savings? Let's say the savings rate is 6%. That obviously you can understand that this is going to be simply 100 divided by 6%. How is it so? Well, you had put certain amount, let's say A. If you put that A amount and you multiply that A amount with the interest rate, and in this case, I'm simply annualizing the interest rate to make things easier. So that is where you're going to get certain payment, right? So all that you need to do is to algebraically transpose the interest rate on the right-hand side by dividing the PMT with the interest rate, and of course that's going to yield you the amount on the left-hand side of the equation. Then that's all the perpetuity is all about. So if a company constantly pays a dividend of 4 forever, and the required rate is 10%, how much you should pay for the stock? That's easy. 4 divided by 10%. Don't go by the formula. Simply follow your common sense. That's it. Present value techniques are being mentioned. Again, you could pause this portion of the video and see it for yourself. Now let's just dive into few of the problems. And these problems are meaningful. These problems are meaty. Suppose you're mulling the idea of investing into a security such that the security will pay $10 as dividend or cash flow each year, and at the end of the holding period of 5 years, you could sell the security at $120. The security pertains to the telecom sector, where the average riskiness is perceived to be 12%, which is the discount rate. The security is currently trading in the market at $90 a piece. What is the most likely action you take? And this is the kind of question you should expect in your Excel exam. So let's first draw the timeline. Always draw the timeline if possible. That's going to make your life easy, and that's going to actually solve the problem in a much more efficient manner. So your holding period is 5 years, right? So this is t is equal to 0, and then this is t is equal to 5. This is t is equal to 3, of course. This is t is equal to 4, 1, and 2. So each of this year, you're going to get a fixed dividend or cash flow of $10 each. And at the end of the period, you're expecting to sell the security at $120. That means that an additional $120 is going to be your estimated likely cash inflow at the end of the holding period of 5 years. Now, given this, the discount rate has been given to be 12%. Okay, and the security under consideration right now is selling at $90 a piece. Now, given all of this information, what we are being asked is, should we what is the action that we might take with the security? These are the estimates that's there in front of you. It's going to get you fixed cash flows of $10 as a dividend each year. The exit value is likely to be $120. Currently, the security is trading in the capital market at $90 a piece. Given this information, and of course, the discount rate is 12%. Given these pieces of information, what is the likely action should you take? Should you invest in this security, or should you not invest in this security? If common sense prevails, then it must dictate that if the future estimated values could somehow be discounted today, then we are going to get certain estimated present value. Remember, the security is already trading into the market, so this is the market value already. But hey, market value per se does not necessarily mean that this is the fair or the intrinsic value of the security, because market can be overpriced, market can be depressed, market can be fairly priced as well. All right, trading only will make sense for me if there is a little bit of inefficiency in the market, because a little bit of inefficiency tells me that I could have certain trading gain, either on by buying the security or selling the security, either on the plus side or on the negative side. So the whole exercise out here is that should we find the estimated present value of the security through the working of the estimated cash flows, that estimated present value must be less than or equal to the market value of $90. Isn't it? Why? Because it is simple. I would not want to pay a security more than $90, given all the discount rates and the cash flows and the other metrics that are being provided, because it's obviously going to be more than the fair value. On the other hand, if I find that the estimated present value is indeed more than $90, or at least $90, that signifies that the equity or the security under consideration is heavily underpriced. And if it is underpriced, then obviously we can expect some sort of convergence going forward, and obviously that's going to yield me a positive gain. All right. So with this understanding, let's now work. How do we do it? Well, we have to again deploy our TVM worksheet. All that we need to do, simply second and clear TVM, and second and clear any remnant memory, and then just keep on feeding the data. You have the 10 as your PMT. You have the 12 as the discount rate. You have the 5 as the number of periods. Then you have the 120 as the future value. You need to find out the present value of the security. Okay, so you will need to feed all of this data. And while I do this, let me also reiterate one fact, that I could have done exact exercises pertaining to all the problems that we have had worked out so far in our spreadsheet. However, had I done that, you would be deprived of the actual working in the calculator, and that's something which I wanted to avoid. I wanted all of you to learn through the calculator, because that's more relevant. All right. So if you do so, you're going to get a value of 104.13 negative, of course. Negative indicates cash outflow that is to be made, or in other words, the investment that is to be made. Now things will get interesting. How? Because the fair value, the estimated fair value of this security, given all the figures, happens to be 104. Let's just ignore the negative sign for right now, while the security is trading at $90 a piece, which means the security, comparing these two, the security is heavily underpriced, isn't it? Security is heavily underpriced. For some reason, maybe market has not really understood the intrinsic value of the security, has not taken the note of the future potential of the security, and that's why perhaps it's actually underpricing the security. which makes sense that should the trajectory be right and consistent as we have estimated, it is going to have some degree of convergence going forward. So if I right now the security is available below its fair value, that means it's a big buy for me. Okay, in real world as well, all other things remaining constant, all other things remaining constant, you would make investment decision in exactly the same manner. From here, let's now dive into the second problem, and that says that an investment advisor, as an investment advisor, your client has sought an advice on the following investment of EasyCom stock. uh, Latest dividend that EasyCom paid was $10. A friend of the investor works in the telecom industry, and according to him, EasyCom is on a growth trajectory for the next 3 years, and hence the investor could expect a healthy growth of 8% in his earnings each year. At the end of 3 years, it is anticipated the EasyCom could be sold at $120 a piece. Latest reports suggest that EasyCom commands a 12% discount rate. EasyCom is currently trading at 115 per dollar. What would your advice be to the client? Now, here, things are getting a little bit more interesting. All right. So now we don't have 5 years, we have only 3 years at our disposal. And across the 3 years, there is a dividend, and the last dividend that was paid was $10, which is likely to grow at the rate of 8%. All right, so that means we could always map the dividend out here, because this is going to grow at the rate of 8%. That means three dividends we could calculate easily. So 10 into 1.08 for the first dividend. So this happens to be 10.8 dividend. This is the first dividend. This is dividend number one. Multiplied once again by 1.08. This becomes 11.664, which happens to be dividend number two. And then we multiplied by this 1.08 once again to arrive at 12.597, which happens to be dividend number three. All right, so we have got these three dividends that the company is likely to issue in the forthcoming 3 years. All right, and it is expected that we could sell this security at out here. The future value at selling price is estimated to be 120. And the discount rate happens to be the same. The discount rate is 12%. And EasyCom's current market price is again $115 a share. Now, given this, what's going to be your advice? Now, understand again, the basic terminology again remains same. No investor in sane mind should buy a security that is overpriced, or it's overpriced, because obviously it's going to get him or her a negative yield. On the other hand, if you're getting something cheaper that's it's lesser than that of its fair value, obviously that other things remaining constant, maybe that's a very big potential buy call. So out here as well, the job remains the same, the logic remains the same, the common sense remains the same. The additional twist to this problem is that now we are not dealing with a constant dividend, but a dividend that's growing, and it's growing at a constant rate of 8% each year. Now, how do we do this job? Well, the biggest problem that we are now faced with is that the cash flows are uneven. So the traditional TVM worksheet is not going to come to our rescue. But can we still solve this problem? The answer to that is yes, we could. How could we do it? So we now make use of the cash flow function in your calculator. If you make use of the cash flow function, the uneven cash flows can be keyed in the cash flow, of course, cash flow worksheet, and then that's going to do the job for us. And how it is going to look like? Well, internally, the calculator is going to work in this manner, because the basic science remains the same. That does not change. we will still have to discount each of these cash flows to their present value and then add them up and then compare them with the given market value and then arrive at the investment decision, right? So your calculator is going to do the same job, okay? But that's going to save you a plethora of time, because in your actual exam, will this type of problem show up? Yes, most definitely this will show up. And obviously CFA Institute would expect you to be nimble with your calculator, to be smart, efficient with your calculator, to be proficient in keying in the values. All right, so let's just do the job. What I want you to do is to press the CF button. In your calculator, if you press the CF button, that may have certain memory or not. So obviously I want you to press the second CEC button as well. So obviously that's going to clear all the remnant memory if there is any. And now I want you to key in the value one by one. So first is what I want to do is, you could do it in either way. You could do it first with in the CF0 itself, leave it as it is, okay? Do not do anything. Simply play the down key once. And now you've got the C01, okay? If you have got the C01, I want you to press the value of 10.8 and press enter, because that's the difference, 10.8 and enter. Press the down key once again, and you're going to get the frequency. Leave it as it is 1. It is going to give you a default value of 1. Leave it as it is. Press the value, press the down key once again. You're going to come to CO02. Press 11.67. I'm rounding it up a little bit. And press enter. 11.67 and press enter. Press the down key and you're going to come to F02. Leave it as it is. Does not matter. You're going to come to CO3. Now, once you come to CO3, feed in the value of 120 plus 12,597. Okay, you could do the math here yourself. 12,597, 12.597 plus 120. And now you get a value of 132.597. Press enter. So now you've fed all the data, all the cash flows as it is required. All that I want you to do is to now press the button NPV. Once you press the button NPV, you're going to get something as I. Once I is being shown, I want you to press the value 12 and enter that value. Once you press the value 12 and enter, and then you should press the down key. Once you press the down key, you'll see that there is something called as NPV with an equal sign, but there should not be any value on the right hand side. Once you have this situation, press the button CPT. If you press the button CPT, the calculator is going to show you a value of 113.32. Okay, what does this mean is that this happens to be the fair value of the security, which is going to pay you a dividend of 10% growing at the rate of $10 growing at the rate of 8% every year. And finally, you could exit at $120 a piece at the end of 3 years. Okay. Now, in this case, what's happening is the EasyCom share is trading at 115, which is slightly overpriced. So obviously, you should not, your advice to your client is not to invest in this, because it is trading at a premium over and above its fair value. All right. You see, we so far gave you valuing, when we are talking about, let's say, fixed income kind of security, a mortgage, a bond, an annuity, a bank savings, interest rate in perpetuity. We valuing them is pretty straightforward. Why they're straightforward? Because first and foremost, except for the annuity in infinity, that is annuity in perpetuity, except for that scenario, all the fixed income securities, all the interest-bearing securities that we have discussed so far, they carry finite life. That's first. thing. The second is that more often than not, we have dealt with cash flows that are constant across time. So when you have cash flows constant across time, which happens with the fixed income securities, of course. So finite life, constant cash flows, and perhaps a face value at the end of the tenor, working through the TVM is pretty straightforward. Okay, but when we want to extend the same logic with an equity, that becomes a problem. Mind you, the couple of examples that we have done previously, in both of these cases, I deliberately gave you that at the end of the given tenor, which was the holding period of the investment horizon, the exit value was estimated to be some finite value. Well, in real life, estimating that final value of 120 or 130, whatever that value was given, is not going to be that straightforward. Why? Because for one couple of reasons that we need to understand. First and foremost is that equity or equity type instrument, they are defined by infinite life, right? When you buy in an equity, you buy in that equity for life, unless of course the company is delisted, restructured, acquired, sold out, court proceedings, NCLT, Chapter 13, etc., etc. Unless that happens, your stake in the company remains intact. That's number one. Second is that equities, of course, again, some of them will pay dividends, some of them will not. The ones that do pay dividend, again, will come with several twists. One is that you could expect constant dividend amount, which is again going to be a little facetious because uh, equities normally do not pay constant dividend. So you would be having variable cash flows as far as dividends are concerned. It could also so happen that the equity under consideration may actually chart the path of dividend growth rate for some time before tapering off or resorting to constant dividend. So with this ambiguities, I would not say ambiguities, with this vagaries rather, valuing an equity through the simple discounting method like that being used in the TVM becomes that much more challenging, that much more wanting, I would say. Not that it cannot be done. In fact, it is one of the basic tools, basic and fundamental tools being used because let's understand one thing. The worth of a security, especially the ones that trades in the capital market, is hinged upon a couple of things or both. One is the periodic cash flow that the security provides, regardless of it being the type of security, whether it's a bond or a equity in fixed income type or equity type. And second is that what is the capital appreciation that you could think of. So equity comes with dividend, which is discretionary in nature. Equity does not come with dividend. The price that you would exit at the end of the holding period may be something else than what you had anticipated. So these are the additional vagaries that I want you to understand. So again, my approach is never to walk you down the path of memorizing and regurgitating certain formula. No, you must build the intuitive block so strong that the formulas should come natural to you. So I want you to pause this portion and then go through this slide once. And without much ado, let's actually dive into a problem. And I read out, Megadolon Earth Moving Company is doing great, having won a 5-year contract from the state of Ohio, USA. The company is planning a follow-up public offer to raise additional funds to sponsor the projects in hand. Megadolon has historically been paying dividends that grows 10% each year. The latest dividend just paid yesterday was $8. It is expected that Megadolon would continue with the same payout pattern for the next 3 years. And thereafter, the dividend growth rate is expected to taper to 5% for the next 2 years. Megadolon could be sold for 105 per share at the end of the 5-year period. The discount rate is 12% for the Megadolon stock. Based on the above information, what should be the fair value of Megadolon Assume no stock dilution because of the additional issuance. All right. So let's again uh, draw our timelines. That's the gospel. All right. So we are talking about 5-year period. It's paying a dividend. The last dividend that was paid, let's term that as D0. And the D0 was $8, and the growth rate of the dividend happens to be 10%. All right. Now there is a little bit of twist in here, is that it is likely to grow at the rate of 10% each year. So we have a couple of growth rates. The first growth rate happens to be 10% out here. 10% out here, and 10% out here. But thereafter, for the next couple of years, the growth rate is likely to taper. That means the growth rate is going to be less. It would decelerate a bit and will only be confined to 5%. Nonetheless, across the period, regardless of the dividend growth rate that we have talked so far, the discount rate is being given as 12%. And here it is being said that at the end of this tenor, it could be sold at $105. Now, given all of this, we are being asked that what should be the price out here? What should be the present value? Because we are talking about the follow-on public offering. So is an FPO. So the FPO price is being actually asked about. All right. Okay. So how do we go about it? So let's understand a few things. And let's understand a few things. So we obviously in this we will have to plan all the cash flows. We have to discount each of these cash flows, right? That's the key. Each of these cash flows will have to be suitably discounted. Okay. But before we discount these cash flows, of course, we will have to project the cash flow that can happen in terms of dividend each of the year, with a 10% growth for the first 3 years, and then with a 2%, with a 5% growth for the next couple of years. That's the twist. So as before, in the previous problem, we already saw that the 3 years 10% growth rate of 8%. Okay, it was 8%. So out here, the first dividend is obviously going to be uh, D1 is going to be D0 into 1 plus G. Okay, 1 plus G. So the first dividend happens to be 8 into 1 plus 10%, or 8.8. Okay. Similarly, D2 is going to be either we could do 8.8, that is D1 into 1 plus G, which is also equal to D0 into 1 plus G square. Okay. And both of them ultimately is going to yield you 9.68. And now we have D3, which is 10.5. 648. However, from here, the D4 and the D5, they obviously is going to have a lesser growth rate. So D4 is going to be equal to D3 into 1 plus, this was my G1, 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 I would say. This is my G2, where G2 is equal to 5%, right? So we could map the cash flows. This becomes my 11.18, and D5 is going to be equal to, similarly, either we can write D3 into 1 plus G2 square, or D4 into 1 plus G2, which is equal to 11.73. In addition, we could sell this stock at 105. Now, for us, calculating the fair value becomes that much easy. All that we need to do is to key in the data. And as before, in the what we are going to use, because these are uneven cash flows, we're going to make use of the cash flow worksheet. So I'm not going to, step by step, I'm going to guide you. I think you are adept enough to do the job for yourself. Key in the value. Before that, of course, do not forget to clear your memory. So the first value is 8.8. The second one is 9.68, that is CO2. Cash flow number 2 is 9.68. Third one is 11.18. Fourth one is, I'm sorry. Third one is 10.648. I'm sorry. 10.648. Fourth one is 11.18. And the fifth one is 11.73 plus 105. All right. So now that we've got this, we have to calculate the NPV. In the NPV, obviously, the discount rate is 12%, as has been given. Press the down key. And if you press the down key, the NPV happens to be net present value. That NPV happens to be 96.49. So that means roughly, I'm going to round it up to 96.5. So this is the fair value of the Megadolon security as on today. So if the Megadolon security comes with a follow-on public offer at 96.5 or less than that, then you should, as an investor, must or could invest in this. The next problem is a little bit more fascinating. And here it says the other details remain saying that we still have a 5 years contract. All the values are same. With the only twist out here is that the tapering would happen after 5 years. In the previous problem, the tapering happened after the third year. In this case, the company is going to pay dividend that is going to grow at the rate of which is going to grow at the rate of 10%. It is going to grow for the first 5 years. And after the fifth year, after the year number 5, it is going to grow at the rate of, the dividend is going to grow at the rate of long-term growth GL in perpetuity at the rate of 5%. This is the data that has been given to us, 5%. Okay. Now, given this, what would be the fair value of this security, assuming there is no stock dilution. All right, so now out here, watch a point of difference. In the previous problem, the exit price of 105 was already being given, but here there is no such mention is there. Why? Because out here it says that the dividend is going to grow at the rate of 5% for the foreseeable future. Okay. Now we will have to approach this problem in a little bit different manner. And let me tell you that this, personally, I do not quite like the approach, the way CFA actually has, I would say, thrusted upon the concept of equity into quants, because it's not advisable to learn the equity models in the quant model out here, because you need to you're building your blocks in the quantitative methods first. But anyway, since it's your text, it's your curriculum, so I have less to complain and more to give to all of you. But let me assure you that if you go through the problem logically, step by step, go through the building blocks, it's going to make sense. You just labor once, and the rest of the things are going to remain with you forever. So let's just again, as before, map. The first job is to map the cash flows. So we can map the cash flows. The first 3 years cash flows are going to be identical out here: 8.8, 9.68, and 10.648, right? So it is going to get, we're going to get 8.8 and 9.68, 10.648, 9.68, 10.648, and hereafter for a couple of more years. So these are your D1s, right? These are your D1. This is your D2. This is your D3. So we have to find out the D4 and the D5. So we could do that. That's pretty easy. So the D4 is going to be 11.71. This is my D4. And the D5 is going to be 12.88. Okay. So now what has happened from D1 to D2, we have the cash flows in front of us. So we have CF0 obviously is going to be 0. You have CF1 as the first dividend, 8.8, which you'll have to feed in your calculator. CF2 is your 9.68. CF3 is your 10.648. CF4 is equal to 11.71. CF5 is equal to 12.88. So given all of this, we have to find out the value. All right. So let's now, I'm going to now borrow the concept of geometric progression out here. You see, after the year 5, it has been mentioned, after the year 5, the dividend is going to grow in perpetuity forever, right? So, and that rate has been given as 5%. So that means in the 6th year, my dividend is going to be 12.88 into 1.05. This is my D6, which is of course my cash flow number 6 as well. That becomes 13.528. Similarly, my D7 is going to be equal to 14.2. We just multiply 13.528 with 1.05. which means that we could carry on this forever. However, our calculator does not have the space to accommodate infinite values. So how do you do that? So if we watch this minutely, we would understand that this is actually a geometric progression. This is actually a geometric progression where the common ratio is 5%, which in our case happens to be GL, the long-term growth. Whenever, and this is something without getting into the weeds of mathematics because that's not required, whenever we have spotted a geometric progression in this manner, which will extend up to infinity, that can be represented, then the value of that can be represented as value of that can be represented as the immediate value, that's from where infinity extends, divided by k minus g. Sometimes this is the same r minus g, where r happens to be the discount rate. Now, this is an extension of Gordon's equation. I will explain this in detail when we are going to study equity. Since this is not a class of equity, hence I'm not going to overwhelm you, overburden you with the concepts of equity out here. Suffice to do the job as has been asked from the point of view of the TVM only. But just know this, that this is a pure infinite geometric progression. An infinite geometric progression in this manner can always be represented like this. This is very similar. Just understand one thing. This is very similar to your perpetuity model. In a perpetuity model, we say that we're going to receive a constant amount of $10 where the market interest rate is 6%. So what's the value of that investment? What you used to do is to calculate this PMT, was to divide this PMT, or the payment we're receiving, by the interest rate, right? We are doing something similar to that out here, where R is the discount rate, G is the growth rate out here, both expressed in percentage. All right. So now that we have done this, let's first understand that what is going to be the exit value. In our case, we are going to call this exit value as the terminal value. Okay. And again, do not be bogged down by the notation or the equation which I'm throwing at you, because unfortunately this has been covered as part of your curriculum in quantitative mathematics, which otherwise should have been moved to the equity portion. I'm constrained to do it. So the terminal value could be represented as value at time period 5. Why at value at time period 5? Because we're taking one period ahead from here, where from infinite time series would start. So we obviously need to discount this, whatever value that we are getting at a D6, we need to discount this appropriately for one period behind only, one period before, just a period before to that only. So that happens to be the 5th period. So out here, the D6 we have calculated as 13.528. This we are going to divide by the discount rate of 12% and the infinite, the long period, the growth rate in infinite period, which has been given to be 5%. All right. So if we do that, the rest of the math is going to be easy. We are now getting a value of 193.25. All right. What it simply means is that we are talking about an investment that that pays interim cash flows or interim dividend, and those interim dividend grows at the rate of 5% indefinitely in the future for infinity. What is the price that you would be willing to pay for this kind of investment? And the answer to that is 193.25. But do remember that this 193.25 is the value at time period t is equal to 5 and not time period t is equal to 0. Hence, it is called as the terminal value. This is a very important concept. When you enter the corporate world, unless you're already working, and if you're working as a financial analyst, as an equity research analyst, you would be required, and any corporate finance, investment banking job, mergers acquisition, you would be required to find out terminal values day in and day out. And in such a situation, these kind of equations are handy. All right. So what did we find out? We found out the terminal value of the equity of Megadolon at the end of year 5 to be 193.25, because beyond that, a constant growth period of 5% ensues in the dividend. Okay. So what has that got to do with my cash flows? Well, my cash flow has now just become modified because the CF5 is now not only the dividend portion of 12.88, but also the terminal value, which happens to be 193.25. The rest of the math is pure easy. All that you need to do is to key in the details. Just key in the details. 8.8 as the first cash flow, 9.68 as the second, 10.648 as the third, 11.71 as the fourth, and the fifth happens to be 12.88 plus 193.25, 206.13. And now we go to NPV. In NPV, we key in the discount rate as 12%, as has been given. Press the down key, NPV is going to show 0, and press the CPT button. It gives me a value of 147.55. All right, so this is what the Megadolon's share price should be if they are planning for an FPO. So the Megadonald's FPO should be priced at the fair value should be 147.55. And if you're an investor, you would be happy to see if the FPO comes out at a price lesser than this. This is how practical work is being done in the real world. All right, so this is again the same equation. This is known as the Gordon's equation, Gordon's growth equation. We have just Gordon's growth equation, and this we have just solved. We took the help of this equation in the previous problem to solve it, and this is how it looks like in the real world. Okay, you can understand that you could do algebraic transposition to find out, given three values, the fourth one could be found out by doing the algebraic manipulation. That's all that is being said. For instance, if the growth rate is being given, the dividends are being given, and the price is being given, you can find out the discount rate. If the discount rate is being given, the dividend is being given, price has been given, you can find out the growth rate, and so on and so forth. So three given, fourth one can be found out. That's all being said. So just to make the point, an example of Tesla has been taken, which is trading at 63, and annualized expected dividend has been 1.76. And Tesla's analyst says that Tesla's dividend is likely to grow at a constant of 4% indefinitely. The word indefinitely out here is important because that allows us to key in this particular equation, make use of this equation. So we are asked that expected rate of return has to be return, the required rate of return the investor should ask for. So all that you need to do is to equate this 63 is equal to 1.76 into, always remember, whatever dividend is being given, multiply this by at least one period's growth rate, 1.04 divided by R. We have to find out this R, and the G has been given as 4%. So you can isolate the R from here, and then R should come out to be somewhere around 6.79%. All right. So what I'm going to do is I'm going to pause here This marks the end of the part one of the time value of money in finance application. In part two, obviously, we're going to cover the rest of the chapter. Thank you so much and stay tuned.